The action in markets overnight was largely the result of slow burn thematics emerging in trading. In Europe overnight, we saw real pressure across the continent with shares in Germany and Italy under extreme pressure, down around 2% as measured by the major indices, and pressure across the continent. That weakness in trading spilled into US trading and was based on data that was released. Now, on Friday night, we'd seen a higher than expected tick up in inflation. That was already a concern. Over the weekend, we heard about the US Appeals Court ruling against the White House's imposition of tariffs in April and striking down a number of those tariffs, subject to an appeal in October. But those concerns really added to uncertainty. And then in overnight trading, we saw manufacturing data and ISM data that suggests that the US economy is weakening. And that led economists to draw on a word that they hate to say out loud, that is stagflation. Rising inflation, that is rising wages, rising prices of goods, and a slowing in the economy at the same time is the worst of all economic worlds. Now, that fear is what caused markets to fall. And of course, once again, the selling was concentrated on those top performing high flying tech stocks. And so the NASDAQ was the worst performing of the three major US indices. Its tumble echoing into trading this morning. And we are seeing futures across the board under pressure. Australian futures down around 40 points, around 0.5%, but we could see further selling pressure. Militating against that was good support for metals. Now, the support for gold is pretty straightforward. In an inflationary environment, gold is favoured. And in an environment where an economy is weakening and further rate cuts are expected, gold is also favoured. So it was no surprise that it traded to an all-time high. Spot prices touched $3,540 US, and we saw futures prices trading even higher than that overnight and again this morning. So that elevated price for gold certainly justifies some of the big rallies that we've seen in gold stocks here in Australia over the last two trading days. Gains of 5 to 6%, quite common even in the biggest stocks in the sector. And so we are likely to see a continuation of that support today, given that record high for gold prices. But it wasn't just gold. As the US dollar weakened, we saw strength for commodities across the board. Iron ore rallied. We saw silver at another 2.5% after a similar gain the previous night. Platinum, palladium continue to feature as their industrial uses are dragging them higher against the precious metals. And we saw good support for oil prices. So some reasons to think that in trading today in Australia, we could see support for the resources sector. That's what spared Australia a lot of the worst of the selling over the last few sessions. That support for resources balancing out the selling in the other sectors in the market. Time will tell if we'll see a similar effect in trading today. But some concerns about the outlook. Gold stocks likely to be a focus. And we are already receiving questions across the board around the idea that tech stocks might be moving back into bargain territory. Personally, I think that's a bit premature. It's reasonable to ask the question, but given that we've only really had a minor pullback and we're still closer to all-time highs than anything else, there is still plenty of room for corrective action. Now, I note that interest rate traders have now moved upward again. Their expectations of a rate cut in the US on September 17th after the meeting there. That, to mine, is a real risk to the near-term future of the markets. We've got real concerns that despite that weakness, the tick-up in inflation might stay the Fed's hand. And with the markets expecting a rate cut as an almost certainty in just under 2 weeks' time, any disappointment on this front could really rattle cages when it comes to the US share market. So one to watch out for. Today here in Australia, we've got GDP data. It's expected to show that growth accelerated in the second quarter from 1.3% in the first quarter to 1.6% in the second quarter. That, of course, would be positive and help to justify the all-time highs we're trading at here in Australia as well. Any disappointment on that number could really hurt the market, particularly given the negative leads we've seen so far. But, of course, any reading higher than 1.6% for the annual growth rate for the second quarter would be a real positive and could support buying in the market. One we'll watch closely today. And of course, it is, although we're coming to the end of the reporting season, there are still a few laggards coming through here in Australia, in Hong Kong, and in the US. But the big event for the market again this week, I think, will be the non-farm payrolls on Friday night in the US. At this stage, expectations have been lowered after last month's revision downward of the previous couple of months, and the much weaker employment situation that was reflected in those revisions downward last month is also reflected in the expectations that this month's read will only be 75,000 jobs. And given that around 200,000 jobs has been close to the average for the monthly read, that does suggest that there are concerns about the outlook for the US economy and potentially justifying that pressure we saw in US trading overnight.